Hi, good evening, everybody. This is the first of the 3-day sessions for Money IQ's this series 6 or the season 6, if you want to call it that. So we finished season 5 towards the end of last year, or series 5, and this is the 6th series. So it's a set of 3 classes. Today's session is, an introductory session, and then we'll go into more details in the next 2 classes. So I'm going to go ahead and just get started, and others will join us in the class. So I want to just start by saying this class is I want it to be very interactive. There will be questions that you have that maybe I say something, it's not clear. Please feel free to just raise your hand. I'll see you on the screen that, you've raised your hand. And if I don't notice, just go ahead and open your mic and say something, and I will slow down. We're not in a hurry to cover the content. More than anything, I want people to learn and get tools that can be, valuable to them in their financial journey. So please feel free. It's a classroom. We're here to learn together. All right. So, I was thinking about this. Normally, this is actually my first time of adding this slide to it. Or why do I do this? Why is this something that I feel it's important to do? So I want to just start by maybe saying 1 or 2 things in this respect. I've had, to the glory of God, some good feedback from people, and so it encourages me. But why did I get this started, in the first place? It's actually born out of my own personal experience to a large extent. There was a season that I was on my own quest to understand money, financial freedom. Why is it that some people have, enough and they live in financial freedom, while it appears that others are struggling? And then I discovered that, the keys are actually pretty simple. They're so simple that many people they are missing it because they are searching for things that are so spectacular. And you see in the course of these 3 sessions or classes that if you can follow the principles that I will be teaching today and in the next 2, it's 1 month for 3 months, that things will really, really start taking shape from a financial point of view. I've had very good feedbacks and testimony from people in this respect. There was a young couple that I started with about 4 or 5 years ago, and they were sharing with me some of what God is doing with them, and it really gladdens my heart, to see people being blessed in that way. So that's why I do it. The reason that people think that money is difficult is because the subject of money and personal finance is not really taught in most communities, in the churches, and in most communities generally. As a result, people lack understanding. And we're looking for the spectacular. We want to win a lottery, if you want to say it that way, and expect things to be just magically happening financially. It doesn't happen that way. It's pretty simple, yet many people miss it. And most of the time, the discussions, anytime money is even spoken of in many of our communities, the focus is on that spectacular rather than these basic principles that are proven and they work. Personally, I also struggled in this area for many years, but I took it on myself to learn. I lost many opportunities, earlier on, but by the grace of God, as I learned over the years and put it to practice, I've seen the grace of God in the area of finance. I tell people it's never about how much you earn. Never. It's about understanding how money works and using that knowledge to your advantage. I was actually speaking to someone today. That's one of the subjects that I taught in this class that this individual took to heart, and it's actually on the subject of mortgage. And she was sharing with me how it has helped her, shaved off years of her mortgage. So knowledge, they say, is power. By the grace of God, we'll be delving into all of this. But I just want to establish why is this important? Why am I doing this? And I pray that God will make it a blessing to you. One thing I also kind of ask is, as you learn, please share what you're learning with others. That's one of the ways to also get better in this thing. Share what you're learning. And my desire really is to help others to start earlier or better than I did, more intelligently than I did. So that's the reason. Like I said, throughout the course of these sessions, these classes, feel free to slow me down, ask questions. Today is class 1. It's a 2-hour session. And we'll focus on some foundational principles. Then we'll start the process that will kind of take us through the 3 classes on financial planning. We'll look at saving, investing, and financial freedom, and the process of all of that. We'll talk through it. We'll look briefly at the subject of the time value of money, and then we'll focus quite a bit on compound interest. That is, someone, I think it was Albert Einstein, that says a compound interest is the 6th or 8th wonder of the world, something like that. When you saw the way it works. And I tell people, compound interest always works. It's just that it might be working against you if you don't understand what's going on. So anyway, let's dive into it. That's a little bit of foundational information. All right. A food for thought here. There's the scripture in Proverbs 21, verse 20 that says, there is treasure to be desired and oil in the dwelling of the wise, but a foolish man spends it all up. The term foolish in the Bible is really, many instances, it's not like the way we think it is. It's simply saying someone that lacks knowledge spends everything that they have. I pray that will not be our portion. And, I was saying this in the last class, that financial freedom really truly hinges on the relationship we have with money. And honestly, I strongly believe that it's more about mastering yourself and mastering your emotion that most people have not figured out how to do. So mastering money is more than anything else about mastering yourself and mastering your emotions. That's why some people will buy what to make them feel good, not thinking through the consequence on their financial future. Because they have not mastered their emotion. Their emotion, their buying is emotion driven, or they are doing it so that they can be accepted in a particular group, so that people feel that they have arrived. Those are things that takes money away from your pocket. So we need to understand what money truly means to us. As we're going through these classes, these are basic concepts, but it's important that I start with it. What does money truly mean to you? Does money mean freedom? Or does it mean something that helps you to show that you've arrived? What does money truly mean to you? What's your self-concept? That's a question I want you to be thinking about. What's my self-concept about money? What does money mean to me? Regarding their ability to be financially successful, what is your self-concept? Do you think you can be financially successful? Do you think you can be financially free, or you think you always have to be working for somebody if you're someone that works? If you don't believe you can do it, you can be financially free, the likelihood of doing it is low. What is your mindset about money? Even growing what you have, what is your mindset? And I also said this in the last class, and I'll say it again, that regardless of who signs your paycheck, I want everybody in my classes, those that have been in the class before, they are free to come back when I have the new session. Everyone can keep attending, But even if you don't come to the future classes, keep this in mind, that regardless of who signs your paycheck, from today, or especially for those that this is the first time you're attending the class, I want you to start thinking of yourself as self-employed, as a business owner. You must learn how to plan and save and invest effectively. Not allow yourself to be dependent on a paycheck or the company. Your company is called You Incorporated. Is the way I want you to think about this. You are the wheels, not a company, not an employer. Yes, go ahead.
I just said that's funny. You Incorporated. I'm sorry.
That's the name of. I want you from today to write that down as the name of your company. Me Incorporated. Every one of us, regardless of who signs our paycheck, we need to consider ourselves as self-employed. That is where it starts. It's a different mindset. It's a different mentality. You know, there's a saying in the Yoruba language that whether the master sells or not, the um the servants, what is not really servant, but the servant's money will be complete because he is not minds. He knows that they will pay him anyway, whether the master is successful or not, whether the boss. That should not be your mentality. You know, we need to go to work if you're working for somebody, or even if you have your own business, thinking of yourself as me incorporated. If this business does not succeed, I am part of the process of failure, whether you're working for somebody or not. All right, so there's some basic. Today, I might say a few things like along this line that are kind of fundamental or maybe even philosophical, depending on the way you look at it. So that is why I want you to always think about the why. I mean, when you start talking about financial independence, your why is important. Your why, it motivates you. If you don't have a strong why, when you face the challenge, like some of what I'll be sharing with us, like, delaying gratification, trying to push that big buy to a future, let what you invest in be what buys that thing for you. When it gets to the point that you are denying yourself of things, if your why, your reason, your motivation is not strong, you will easily fall back. So I want you to think about your why. I think on the next slide, I might actually ask us to say what might be some whys, but we need to keep a mindset that understand why is this important, that I'm financially successful or independent. Your goal has to be, very, very clear, because it has so much strength or power to move you towards it. It serves as a reason for you to wake up, to take the pain of some of what I'll be teaching us in these 3 sessions. So please, let's think about our why. What is my reason for financial freedom may not be the same as yours, Sister Celeste, for example. Everybody will have a reason, but you need to have your own why. Why do you want to have the ability to manage your finances successfully and be independent of a company, for example, if you work for people? And I tell people, I will get to some of the content on, even if you run your own business, you need to, talking about being a business owner, you could be a self-employed person that unless you are working, there is no income. If you are at that stage, you are still not financially free. Anyway, we'll talk about some of these key things as we go along. So what is your why? To keep that in mind. And I like to talk about this. Time will fail me to delve into it in detail, but I want to quickly just talk about this, that financial independence is as a result of breaking what they call Parkinson's law. Parkinson's law states that expenditures always rises to the level of income. It's a law. They call it Parkinson's law. The key to financial success, I'm talking personal finance now, not necessarily, business, but personal finance is breaking. Even in business is the same. If your business begin to make a lot of money, and now you know, that's when you need to now rent a big office. That's when you know that the car that you're using for the business is not good enough, so that you can, attract different clientele. You want a bigger brand car or whatever. Those are the kind of things that will push your cost higher than it is, and you'll never come out of it. You never really, make a break even or profit. And so this is so true. Even if you've listened to the news, it's so sad along the lines of lottery. There are many people that win lottery, yet they remain broke afterwards. Many. So I tell people it's never about how much you earn. It's about how much is left over from what you earn, and how hard what is left over is working for you. That is the secret of financial independence. Write that down. or make a mental note of it. It's never about how much you earn. If it is, a lot of these like sports stars that they pay multi-millions of dollars, contract a year, 2 years or whatever, they will never be broke. Yet many of them, they end up broke at the end of their active, sports years and career. Why? Because they have not developed the correct concept to be able to handle that level of wealth. It's never, please write this down. It's never about how much you earn. It's about how much is left. You see where Parkinson's law becomes important, because little or nothing will be left if you don't break that law. You see people that earn millions of dollars a year. After many years, they say they are broke. Why? How? It's because Parkinson's law has taken hold of them. They've allowed their expense. If this is their this is their expense and this is their income. And instead of just keeping the gap as it is, as their income grows, they allow, their expense to also keep growing. Whereas if this is your income and this is your expense, as your income grows, you need to keep your expense where it is. Now, some things might allow you to grow, but it should not grow at the same rate as your income. This is the challenge many people have that keeps them in poverty. We must not allow our income and expenses to grow at the same rate. In fact, every increase in income should be seen as an extra dollar that should go into your financial independence account. So those are kind of my philosophical starts. I always like to say that those kind of things that I just said at the beginning of these classes, because like I said, money is really, financial independence comes from mastering yourself and your emotions. If not, we will buy what we don't need to impress people that don't care. And then as a result, the money that should be, and you'll see why it's important to be able to plan and have that excess as we go along. It makes a big difference. Once we start getting into some of these elements of time value of money, I will share some things with us. So anyway, let's now start going into some elements of financial plan. Like I said, please feel free to slow me down or open your mic and talk. This is a very open class, very informal. I record it so that we can share with us afterwards, but it's not, it's nothing formal. Just sharing what God has helped me to learn over the years. So the first thing I want to teach us in this class is what is called run rate. Run rate. Please, I expect us to be taking some notes here. Run rate. Run rate means how long it will take, assuming no money is coming in anymore. Your run rate is how long it will take before whatever is in your hand gets to zero. It's called the run rate in personal financial planning. There are other terms for it in the business world, but it's called run rate when it comes to personal financial planning. And for most people, particularly in this part of the world, the run rate is less than 2 months. That is, in less than 2 months, if money is not coming in, they will be on the streets. It's because of Parkinson's law that is, ruling their life. They spend more than they make. In fact, like I was using this illustration using my hands earlier on. If this is their income, this is their expense. So the delta, the gap is filled with credit. And that is one of the worst things that can happen to anyone. We need to be skilled at managing finances beyond paying our check, our bills and managing checkbook. That's all most people know how to do, or that's all most people just kind of focus their attention on doing. Okay. Talking about financial goals, there are a number of questions to ask yourself when it comes to really thinking through this subject of financial goals. Please, if you have a question, feel free to raise your hand or open your mic. Questions I would like you to kind of start thinking about if you haven't done this in the past. For those that have been in the class before, see me, share this. Okay, I see someone. Philip, your hand is up. Go ahead.
Thank you, sir. Yeah. Now, the run rate you mentioned, I would imagine you're referring to, that would be the free cash flow, right? After perhaps we have
no. Okay, finish your question, please.
Yeah, so I would imagine this run rate you are referring to, it will be after we have probably taken out what would normally, on a good day, go into savings or into investment. The free cash flow that is left, if it can take us for minimum 2 months, is that it?
Yeah, that
Or,
can it. I will show you the calculation. In fact, you're going to do an exercise on run rates shortly.
okay.
Yeah, but that's kind of it. You're along the right line. But from a personal finance point of view, I want to, show you the specifics in a minute. Okay. So good question. Question I'd like you to ask yourself is, what do you want to earn this year from all your service? I told you should become a me incorporation. You should have multiple streams of income. Even if you are an employee to someone, that should not be your only source of income. You should have multiple streams of income. And you should be able to say, for this year, this is the amount I'm planning to earn because of XYZ different, income sources. 5 years from today, next year, this is what I want to be earning. This is where I want to be in terms of net worth. And we'll talk about all of those terms in a minute. And the question is, what do you want to do to achieve those goals? And we're going to work a lot of examples on, and I will give us assignment, those that benefit most. I was sharing with us at the beginning, a young couple, they were in my class a few years ago. They were sharing with me recently how God has used it to bless them, and it blessed my heart. Both of them are doing very, very well. These are things that they didn't know before they had the opportunity of being in some of my sessions, and God has used it to bless them. So we need to be thinking about, where am I going? Where am I? How do I get from here to there? What is my plan? What do I need to do on a daily, weekly, monthly basis to get from where I'm at, just as any business does, to go from where I'm at to where I want to be? What do I need to do? You need to be very, very clear about those things. If not, you will live your life almost like in a blur. All right, Philip, I see your hand is still up. Did you raise it back up or? Okay.
The previous hand, sorry for that.
All right, so back to your question, Philip. In fact, this is an assignment I'm going to ask everyone to do, especially those that are in the class for the first time. There are a number of people on the line that are attending this session for the first time. I'm going to give us an assignment after this class, and I want you to do it by yourself. If you are married, with your husband or with your wife. This is so important. There are 3 definitions you need to know from a personal finance point of view. 3 of them. I mentioned run rate earlier on. Run rate is in time. That is how long it will take me to spend up what I have if nothing else comes in for whatever reason. That is your run rate. For most people, it is less than 2 months. Your burn rate is how much you need to meet your need on a monthly basis. So burn rate is like burning something, it's dollars, whereas run rate is like time, it's how long something can run for. And then the third thing you need to define for yourself is your net worth. And I will just quickly go through an example to explain these 3. And Philip, after I go through this, please see if it answers your question or you need a little bit more clarification. So let's start with burn rate. It's actually pretty simple. You need to know, and it's amazing, and it's sad for me to see some of this. Most people are, where did all the money go? It's because they do not know what they are spending on every item of daily need. Is it rent or mortgage? Can they even afford to live in the house they're living? They don't know. We'll talk about some things when we get to mortgage in class 3. Is it rent, mortgage, electricity, internet? I say to this tiniest thing, you must know how much you're spending, and you should know the sum of everything on a monthly basis. Not that you should have an idea. I'm not talking about having an idea. If you want to truly be financially free, financially successful, you need to learn to be detailed to that level. How much does it cost me to pay? I'll give you, an example. We used, when we moved to the US originally, it was many, many years ago, we used AT&T. And we were making calls. At the time, phone call to Nigeria, there was no mobile phone like it is today. I'm talking about late 90s. So there was no mobile phone, availability in Nigeria. So we used to call international direct dialing from our house back home to Nigeria. And there was a service that AT&T had that there was a month that it cost us, I think it was $300 or $400. I'm like, man, for what I was earning at that time, that was a lot of money. I can't afford to spend this kind of money on the phone. So we had to go and talk to somebody. Actually, we spoke with someone and said, have we heard about AT&T one rate plan? And that if you pay a monthly fee, this was a whole thing, that you won't have to pay based on use. It's just a flat rate. So we asked, and the people on the line said, oh, who told you about that? I said, what do you mean, who told me? Because the system will cheat you. If I didn't know that that money is above what I should be spending because of my income level, I will just keep spending until I will have always been in the deficit or negative. Anyway, to cut that long story short, I told him I was going to cancel the service, and then he gave me that service. I can't remember the actual amount, but it was like maybe $60 a month. The other one, you don't pay a fixed fee, you just pay per use. But this one, you just pay the fixed fee, and there was no per use charge. And it brought our cost down. How did I know that? I already know my income and everything that I spend money on. And I knew that if it goes above whatever, let's say $100, I will be in trouble. That was why when that bill came, I knew it was kind of excessive. Many people don't truly know what they spend for what. And we need to know those kind of things. You need to read your credit card bill every month, line item by line item. There should be, yesterday, somebody might say, well, this is trivia. I had to call the credit card company to cancel a credit card yesterday because there were 2 charges of $9.99 twice that I didn't authorize. $9.99 may look small, but that is money that I can invest. I didn't need to give it to a credit card company. So the company that put it on my bill, I had called them and they still didn't cancel it when it came. So I just called the credit card company, told them it was not an authorized bill, and canceled that credit card. So they can't even charge me. $9.99 is $120 a year. That is a lot of money. Many people don't think that way. Why? They don't appreciate the fact that every penny counts. Every penny. It was Rockefeller that they said if he's walking on the road and he sees a penny on the floor, he picks it up. And he says something like, the guy that lost this penny does not understand the value of money. So please, it's very, very important that we know everything we spend money on. I think this is pretty important, and I'm spending some time on it. When we get to budgeting, we'll talk a little bit more about this, at that time. So your burn rate is your monthly expense, everything totaled up. Your run rate is a function of so let me current assets. Maybe I need to explain a term here. Your current assets are assets or things that you have, that are like cash or relatively liquid. It may not be cash, but it's liquid. It can easily be turned to cash. It could be like a short-term investment in a certificate of deposit, for example, for let's say 1 month. That can be considered a current asset. In the business world, current assets really is anything, it's either cash or something that can be turned to cash within 1 year. In the business world, that is the way current asset is defined. But when it comes to personal finance, it's a much more shorter term. It's anything that's cash or can be converted into cash in a relatively short time. I'm talking about a month. I can easily just turn it into cash if push comes to shove. That is current asset when it comes to personal finance. Okay, so run rate is how long you can survive on your current assets if no additional comes in. That is what your run rate is. Yeah, Philip, I see your hand is up. Go ahead.
So would your stocks investment qualify as part of current asset from personal standpoint, since it can readily be turned into cash?
No. No. The reason I'm saying that is you should not be selling your stocks to meet your short-term needs. Yes, it can easily be sold, but you should not. And you, as we go on in this class, you will see one of the reasons I say that. The key to making money in the stock market is time. The moment you convert it into, you sell a stock, it loses the power of compounding and time. So we must never consider our stocks as a current asset. It's a long-term investment. Your time frame when it comes to stocks is minimum, I tell people in this class, 10 years, minimum. And you see it when we start looking at and we're actually going to get there today, as when we start looking at compound interest. It's about that 10 to 15 year time frame when the true element of exponential function in the compound interest equation takes on a life of its own, and it truly benefits you. So if you already lost time by converting your stocks into cash, you kind of just keep going back to day zero, instead of allowing things to compound. So please, I like that question, and I'm glad it came out. Please note, for those that have stocks investment, and I hope we'll get more into this later, I hope we all are kind of thinking about that. We'll be talking about it quite a bit in this class. Your stocks are not current assets. Your stocks are intended to be long-term investment. Minimum time frame is 10 years for you to benefit from it. And I will explain that more when we get to it. I hope that answers your question, Philip. All right, thanks. Okay, so run rate is current asset as I've defined. Again, not as in a business. A business time frame is 1 year. I'm talking something you can convert quickly, like short-term CD. You actually put it there like savings, cash. You put it in that just so it's not in your hand. So it was intended to be relatively cash. If you divide that by your burn rate, in this example, I said, assuming the total of all these little expenses is 5,000. And if that individual has cash, savings, and other liquid assets that can be turned into cash in a short term, totaling 10,000, then that individual's run rate from a personal finance point of view is that current asset of 10,000 divided by how much it needs on a monthly basis, term burn rate in personal finance, and that individual's run rate is 2 months. So that's an exercise I'm going to ask you to do for yourself. Remember, your stocks are not to be included here. It's cash, savings, and other short-term money equivalent, whether you have money in the money market or short-term CDs, not more than 2 months CD. Once it gets out of 3 months, then that means you have other things that covers your first two months for you to include it in this calculation. Okay. All right. So those are 2 things you will need to work on. Yes, Sister Celeste. I think 2 hands are raised. Sorry, I didn't see the first person quickly. But go ahead, Sister Celeste. We'll start with you first.
Yes, Uncle Larry. You said that stocks are long-time investment, and you have to kind of calm yourself down and be patient for at least 10 years to have an investment. I mean, to have to profit from it, to see a good result. So yes. My question is, for instance, because of uncertainty, if for instance you have let's say $50,000, right? Because of the uncertainty, you may think, okay, you know what? Let me just put maybe 30 and leave this other 10. I mean, the other 20. If just in case if things get rough, then I'm safe. But if I see that the 30 that I put is growing, then I can add more. So your advice would be to just if you're gonna invest, just take that chunk, put it there, and in other words, forget about it for 10 years, or live in that kind of, it's a limbo, but because tomorrow doesn't belong to us.
Yeah.
I don't know if I explained.
Oh yeah, you explained it, Sister Celeste, and I get this question a lot. I can't say this enough. If you invest, and I'm not sure if I'll get to that portion of the class today. If not today, it's going to be the next class. If you invest in the stock market with a short-term time frame, you are going to lose money, period. I can bet you are going to lose money, because the market is moved on a daily basis by those they call day traders. Day traders are not investors. They are individuals that are just skimping and trying to make money from the movement of the price of the stock. Price of the stock goes up and down based on the emotion of people. Look at what is happening right now to the war in the Middle East. As a result, the price of petrol or crude has gone up. And stocks that are in that business, their price have gone up as well. You know, there are people that want to simply put money in and take money out when that price gets to a high. Who knows, maybe tomorrow the war is going to end, you know, and then everything changes. Overnight, before they wake up, price that is 92 is now 87. And the $5 that they are thinking to make, they are probably now in the negative. I can't stress this enough, and I'm going to teach you about this, Sister Celeste. Stock investment. The first thing I always tell people, and I believe we'll get to it today, is you need to have your run rates must be minimum 6 to 8 months. You need to have enough, because things are going to go up and down. Before you start putting money into stocks and stocks investment, you need to make sure you have 6 to 8 months, preferably 8 months. Some people say 6, but I just say 6 to 8 months of your run rate. You have to have a run rate of at least 6 to 8 months. Living money to cover your basic living expenses for at least 6 to 8 months. If in the case of this individual, if the bond rate is 5,000, it needs to have about 40,000 set aside in savings, cash, and other liquid assets. I'm talking short-term CDs, short-term money market, or government type investment that I will teach us later. Okay. If let's say that has 50,000, that 40,000 needs to be set aside. Only 10,000. And I tell people, money that you put into the stock market should not be money that you need for bread tomorrow. It should never be that money. It should be money that you are willing to lose, and money that you're also willing to leave in that investment for at least the next 10 years. Don't go, and I was teaching, I think I even posted that teaching on the platform. I taught in a forum, they call it Nigerians in West Texas. They invited me and I taught on some of these things about 2 months ago or thereabout. And I was explaining this to people, that it's so important that you allow money, the power of compounding, to work for you. If you don't, you're going to put yourself at a big disadvantage. Because if you sorry, someone wants to come in, let me let them in. If you take that money that should be left in the market for a long time, if you take it out because you did not plan for the short term need that may come, maybe someone is out of work. Generally speaking, most people can get something to do within about 3 to 6 months. That's why I always advise an extra 2 months of living expenses. Your run rate should be at least 6 months before you put money in the market. So for the example you give, if that person's bond rate is 5, put 40K in this liquid asset, and then the 10K is what you are willing to, you should invest, because you need money in case something happens, some challenges come, So please, I want you to understand that money that is placed in the stock market should not be considered as money that you can go and take tomorrow for living expense. It is meant for future. It is meant for at least 10 years from the day you put it in the market. That's about what it takes for you to benefit from the ups and downs and the overall trend of the market. Does that make sense, Sister Sims?
Yes, sir, it does. Thank you very much.
All right, and we'll talk more about it actually in the, either tonight or next class. Yes, Philip.
Yeah, so thank you very much. Right, it's like, yeah, you really read my mind and you were able to answer the first question I was going to ask, which is around. I mean, I pretty much have a good handle of what my burn rate is. Yeah, as a matter of fact, it's right there on my phone, so I can tell you what it is right there. So I was going to ask, what is really the what would be the advisable range for the run rate? And I think you eventually mentioned it, between 6 to 8 months. Now, the question will be, is that dependent on, or does that depend on your geographical location? Say, it's because you are in the US and probably the average rate of you being able to get another job is probably than about, if I was in Nigeria or based in Nigeria, would that be the same, guideline that you would have given? That's one. The second one is, would you advise, and this advice, does it also depend on how old that person is? For instance, if you are heading towards retirement, why do you have to really bother? Why not focus more on investing and just, rather than minding or being careful of what the run rate is and all of that? So I just want you to
I get your question. Excellent question. And we're going to get into these details when we start talking about investment vehicles. And also I'm going to talk about assets allocation and diversification. That is not in today's class, but we're going to get to it. I think that is in class 2 or the beginning of class 3. The key to investing to successful investing is asset allocation and diversification. They are different things. Asset allocation is really, to answer your second question first, is really a function of knowing how much should be in what particular type of investment. And as you change in age, to the point you were making, your allocations will not be the same when you are age 60 as someone that is age 20. Age 20 has a longer runway. So the amount that will be in the cash or close to cash equivalent to them should be much lower than someone that is 60, 65. You see what I mean? So it's the allocation that you use to manage that. The principle is still the same. It's where is that money will determine how much you can take out per time and not hurt yourself, either from a tax perspective or from just having money that you need perspective. So use allocation to so it's not essentially the same for everyone allocation point of view. It changes based on your stage of life. And that's how you take care of, should you be bothered around? You need to be bothered about your run rate or burn rate anytime anyways. However, your allocation is how you take care of being able to withdraw money from your investment without overburdening yourself with tax. And to your first question, it's mostly for the West that 6 to 8 months really truly work, because when you go to like a country that the unemployment rate is much higher, or it's much more difficult to get a job, then you need to adjust it for that environment. So if I was teaching an audience that is based in Nigeria, I will use the statistics of Nigeria to figure out what should be the right time. In Nigeria, if you are a professional, let's say you're an engineer, I think probably within a year, you should be able to find something. It may not be the right thing, to kind of at least get going after school, or let's say you're out of work. So I wouldn't use 6 months from Nigeria, for example. So, but if you're in a Western country with a very low unemployment rate in the range of 5% or less, this is the kind of numbers that they will quote for you from a financial planning point of view. You need to have a run rate of 6 to 8 months. However, it should be adjusted for the environment you're in, to answer your question. I hope that helps. Does that answer your 2 questions, Philip?
Absolutely. Thank you very much.
Excellent. So we've talked about burn rate, which is the money that you need to take care of all your basic needs. Run rate is how long money that is cash or close to cash will last you if nothing else comes in. Let's say someone falls sick and is whatever. And there are many things people do, but how long will you last? And then the third one, it is an assignment we're all going to do. We don't have time to do it in class. I will have asked you to do it now, but it takes a lot to do this. But I tell people, for you to really benefit from this class, you must be willing to do the assignments that I give you. If not, you will not benefit as much. So the third thing is your net worth. Your net worth essentially, if you run a business, is what they call your equity. Is the difference between everything that you own, whether it's current assets, which I explained earlier on, short-term things, or your long-term assets, your total assets, and everything you hold, which are your liabilities. And I have an example on the screen right now that when you do your assignment, you can use. Now, your list will not be the same as the example that I have on the screen. But let's just use this individual X that I have on the table. This individual owns 2 houses. So when you do your own assignment, you're not going to show this to me. This is between you and your spouse, but please do it. Let's say you have house number 1. You put the address of the house and say that house is at market value. Today, you can get the market value of a house from Zillow, or there are other Association of Realtors and things like that. You can get the market value of a house very, very easily. So at market value, what's the value of that house? Number 1. House number 2, located at location B. This is the current market value. Now, on your right column, so you do this like an Excel or a simple table. On the right column, these are the things that you hold. The things on the left are the things that you own. In accounting, they call it assets. And in the things you owe, they call liabilities. So let's say you owe a bank 185,000 on the first house and 149,000 on the next house. You write it on the liability part. Now, stocks, remember, these are long-term assets. From what I've taught us tonight, I can't say that enough, and you'll see the reason more when I get into that. Your stocks must be listed as an asset, and it's a long-term asset. Now, your IRA, if you work for a company that has a 401, 403 and all of those, 457, you list it. If you own a car, I tend to tell people, I personally may not even include a car, but it's okay, you can include a car, because a car it takes money from your pocket more than anything else, but you can include it at its market value. And then your savings, let's say this individual has a savings. The total of everything, in your case, I will expect that it's more than this list, but you get the drift. Everything that you own, list them at their market value and total it up. And then on the right column of the table you are going to prepare, list everything you owe. In this case, this individual owes money on both houses, and he also had credit card debt of 15,000. The sum of that is 349. The sum of what he owns is 453. The mathematics of calculating net worth is the difference between those two. Between your assets of 455, I think I wrote 453 and then 455, excuse me on that. The difference between that 453 or 455 and 349 is actually 453. It should be this correct. The number here is 453. And the difference between those two is 104,300. So this individual's net worth, you need to know this. The reason that is important, you will see it when I start talking about, I will show you a table on compounding and how compounding works, because what you truly want to grow is your net worth. That's what you want to grow. You want to continue to reduce your liabilities while you are increasing your assets. And your assets is something that makes money for you or has value that can truly be converted into value. That is an asset. So these are the 3 things that I'm going to give us an assignment, and I'll send that to us. I'll post that on the forum after the class. There are 3 assignments from today's class, 2 or 3. This is one of them. Calculate these 3 for your family. Please, I'm not asking you to show it to me, but if you have a question and you need me to help you, just reach out to me outside of the class and I will talk you through it. I'm not saying you will show me the numbers if you want to. Some people feel comfortable doing so, but please, you don't need to. But my point is, you need to know these three things. You need to know how much. Your burn rates, you need to know that to the level of the last thing. Now, I'm not saying to be counting penny to the point that, you know, if you're missing $1 or $2, you're having nightmare. No, but you need to know these things as much as possible. Then your run rate is, you know, how long it will take for somebody to be out of, you know, a home, to be on the streets, not to be able to meet their basic needs, if nothing is coming in for whatever reason. It's kind of an extreme situation, but it's important to know. Like I said, statistically in the US, it's 2 months or less for most people. That's sad. You know, they can't even invest. And then thirdly, your net worth. Any question on this explanation on this slide? This is a very important slide, and the reason we need to understand this, you will see more as the time goes on. Any question? Is it clear what I'm asking us to do in this assignment 1?
It is in summary, the burn rate is your expenses.
Exactly.
Okay.
To the level of detail. The reason it's called a burn rate is so you look at it as it's going to even burn you if you don't know.
Okay.
Go ahead.
All right.
Yeah, finish. I think you're summarizing it. Sister Celeste.
Oh, no. What I'm saying, because I understood the run rate is what I need in case, let's say, in case I lose my job, right? At least I need 6 to 8. Not even when income is not coming. It's just like I have no income. That's just, I'm gonna put it that way.
Yeah, exactly.
Okay. That is that's my run rate. What can allow me to continue running when nothing is there? That's what I'm saying. Yes. Yeah. And then the burn, the expenses, and then that's basically it. So I just wanted.
Exactly. Thank you. And your net worth is the difference between the things you own and the things you hold. And you need to know this because that is truly what you want to keep growing.
Okay. Now I see stocks here, but I think we are not supposed to add stocks, right?
No, but this is all your assets that you're listing now. Both your clients.
So don't add it as something that is going to help you when on the run rate.
It's not included in your burn rate.
On my burn rate, but yes. it has to be in here. Okay.
Exactly, because you still own it anyway, so it's part of your asset. It's just that there are 2 classes of assets. There are short-term assets and long-term assets. Short-term assets are things that are either cash or can be converted to cash in a short term. And I'm telling us that for personal finance, you need to consider a time of within a month that you can consider turn that into cash. In the business world, in financial accounting, it's 1 year. That's the way it's measured. Something that you can convert to cash within a year in financial accounting. But we're not talking about financial accounting. We're talking about personal accounting. The time frame is less. Okay. So, but for assets, generally, you need to now add that 1 month thing, and things that are like a house, they're all assets. So it's both short-term and long-term assets that goes into what they call total assets.
Okay. One more thing, Bro Larry. As couples, for instance, we live like in different parts of the world. As a couple, when we combine what we have in Nigeria and like in Angola and what we have in the USA, right? Okay.
Yes.
Or we do is separate like what we have in Angola and what we have in USA, like 2 separate.
Yeah, you need to, at the end of the day, you need to combine it all, be able to see the full picture.
Okay.
Yeah. You need to combine it all. one thing that, to the question that Philip asked earlier on, the run rate in the US is not the same as the run rate in Africa. Run rate when I teach someone in the West is between 6 to 8 months. If I'm teaching someone in Africa, I will give you a run rate of maybe even 1 year, because it might not be easy to get a job. So based on the statistics, apart from things like that, in a couple, regardless of where you're living, you need to have one picture because you are a couple.
Okay.
And when I teach us about budgeting, I will share 2 separate budgeting sheets, one for singles and one for couples.
Okay.
Good question.
Okay.
Thank you. So all of that takes us to this very, very important slide.
If you go back, sir.
Okay.
I was just waiting for Celeste to conclude that question. Now, looking at this, and I know somewhat this also my question might be related to portfolio or investment allocation, right? Since both of them are related, net worth and your bond rate, right? In a way, right? So the question is, considering the fact that if I put fund in some short-term instruments and I put it in long-term instruments, and I also look at the rate I'm paying for my mortgage, I may be tempted to say, yes, I would want to quickly offset my mortgage. And then because there is higher, there is less likelihood for me to lose my job at this time, so that the focus at the current time is just to offset mortgage, remove all those the interest and all of that usually comes up front. So the question is, I know that might also tilt into how you allocate resources and what have you. I want to hear your advice on that, on how one should really manage it, because if you really, you can't be doing one and not looking at the other one. Yeah. Now, the second question will now be on this net worth. Again, this is an absolute number. I mean, this is an absolute calculation. Is there some ratio, acceptable ratio, that you would advise that one could set as target, maybe ratio of your net worth to your liability or to your assets, that kind of thing? No. I don't know whether you have those numbers.
Okay, so let me start with this second one. The reason you want to have your net worth is because that is what you're going to measure over time. That is the one that you need to have an idea. Where do I want to? And you see that I'm going to get to the compounding thing in a little bit. Where do I want to be in 30 years? What you're asking is, what should my net worth be 30 years from today, regardless of what I put the money in? What should my value, personal value, financially speaking, what should it be 30 years from? So it's not a ratio thing. It's just your worth, your weight financially. That's all this is. So it's not like in business where they tell you that, your ratio of liabilities to asset must be at least covered 1 to 1 or 2 to 1. No, that's not the way this works. That is really covered under your run rate, okay? Because your run rate is where you are kind of looking at so that you can avoid bankruptcy, which is why they use it in the business world. They say you must have your assets covered at least 2 to 1 or at least 1 to 1 or something like that. That is really more under the run rate mindset, because your time frame as an individual or as a couple, as a family, is not the same as a business, right? So run rate is what you use to kind of cover. It's like current asset to bond rate ratio is really what it is, and that ratio must be at least 6 to 8 in the West. That's really the only ratio that makes sense. When it comes to net worth, this is where you grow. You grow. Run rate is not grow, it's just money that you need for the short term. Okay. I'm going to ask you if that answers your question, but I want to address the first one, and it's keeping me because it's a very, very important one. What was the first question again? You asked a very important first question. I should have tried to address that first.
Yeah, I think I'm sorry I'm eating at the same time listening to the session. So I appreciate your answer on the second one, and I think it makes sense. You use your net worth. You use your net worth to determine what eventually your future target is. Why you use the ratio of the current asset, that's your burn rate, to continue to manage your exposure.
Exactly, to continue to manage your exposure. I think you were also saying something along the lines of, can I take money out of this to take care of my mortgage or something like that?
Yes, that one was with respect to, I know the rate I'm paying on mortgage, right, is coming with at a cost, and I'm like, oh, should I be putting money aside trying to maintain my run rate, or just
all long term? Okay, so again, this is where these things are so important. From Philip, thank you for asking this question. This is where most people get it wrong. If you understand what I'm saying and you follow it, you will do well. We must not mix, and I said it like this earlier on, let's not put money that we need for bread into long-term investment. If you do, your long-term investment is not going to function as a long-term investment, because you'll be forced to dip into it when you eat a rock. And you've already put more than you should put into it. You've taken money that should be left aside for your run rate, you've put it into long-term investment. They must not be mixed up. We shouldn't go take money, because the moment you take it, you break the law of compounding on that money, and you're back to square one each time. So please, it's very, very important. I understand the point you're making. When push comes to shove, I tell people, look, you have to do what you have to do. Let's say somebody had a run rate of 6, even had the 8 months, but life happened and they still were not able to get back to work after 8 months. Am I going to say if that person has stocks of 50,000, they can't go and take from it? No. Is he going to go on the streets and, when there's no money to take care of his immediate needs and he has, 50,000 each, he wouldn't. So you see what I'm trying to say? Some things might not really allow you to follow this to the letter sometimes, but if you follow this as I'm explaining it, it allows you. So let's say that individual within the 6 months, ultimately the goal is to kind of get back, to where he was before financially, before it gets to the point of having to dip into long-term investment. And by God's grace, is able to. And if you give yourself that time frame, in the West, generally you will be. Now, but let's say something now happens, by all means, you have to go take out of that. You break the power of compounding on the long term and take care of your short-term needs, period. Ideally, once, let's say that individual after 3-4 months now was able to get back on their feet, they still have another 3 to 4 months of burn rate, before they will have gotten to zero on their run rate, right? So once you get back, your first thing to do is to build back your run rate to 6 to 8 months. Before you start putting money again back into long term, you build back your run rate to another 6 to 8 months, and then you put money back into long-term investments. Now, if you are working for someone, maybe they're going to keep taking money out of your income anyway, and that's okay. I'm just saying, in principle, you want to build back that your run rate back to about 8 months, and then you put money back into the long-term investment. But I hope that makes sense, Philip. We must not confuse the two. If not, we are going to break the power of compounding. Does that make sense?
Yes, sir.
Excellent. Now, this is a very, very, it kind of brings a number of what we're talking about together. So the first step when it comes to financial planning is that you must determine your current financial status. Which are those 3 things that we have just talked about: your net worth, your burn rate, and your run rate. Run rate, and I want to kind of explain a couple of important terminologies here, is a wealth indicator, not a riches indicator. You see, a lot of people appear rich, but they are not wealthy. They appear rich because they buy and they drive rich cars. You know, and that's the challenge in the West because of the credit system. People live big because the credit system allows them to do so. That individual's run rate may be just 1 month, yet is driving a car that can be the cost of a house. Run rate is a wealth indicator. If your run rate is 36 months, you are wealthy, because that means even if money is not coming in for 3 years, who cares? Your goal is to grow your run rates significantly over time as well. The key thing you're growing is your net worth, but you should be able to have some comfort level when it comes to cash flow capabilities with time. So you're not dependent only on like a savings. You should have cash flowing from various means. And I said this at the earlier on, you know, it's never about how much you earn. It's about how much you keep and how hard what you keep is working for you. Your goal is to grow your assets and keep your liabilities and expense controlled. Remember Parkinson's law? We need to break Parkinson's law. Most people are buying liabilities when they think they are buying assets. If you've read, I always share some books on our platform to read, and our WhatsApp platform. If you've read Rich Dad Poor Dad, Robert Kiyosaki's book, he used these financial statements, you know, to kind of explain a few things, and I want to kind of use it also. The cash flow of an asset, he explained, and I like it from a from an accounting point of view. His definition does not really match accounting definition, but it really is the best way to look at it. That is, an asset is something that produces income, whereas a liability is something that requires you to spend money on it. It results in expense. Liabilities results in bond rates. Assets results in income. Okay, so this is the cash flow of an asset. This is the cash flow pattern of a liability. And he explained in that book that this is the cash flow pattern of a poor person. A poor person probably has a job or some kind of income producing endeavor. Maybe in this instance, a salary. It could even be, you know, a business. And everything goes out of him or her in the form of expenses, in taxes, rent, food, transportation, clothing, and so on and so forth. So he never gets money put aside to grow his asset base. You can see that his balance sheet is zero. He has some people are high income earners, but all their income is going out as expenses. They are not different from a poor person. They just look rich on the outside. This is the cash flow of most middle class people. Middle class, on the other hand, they own things. You know, the poor person does not own anything. His balance sheet is zero. But the middle class have a lot of liabilities. They have a home that they have mortgage to pay, cars that are what the cost of a house that they are still paying and they bought on credit card debt, school loans. I was watching a program, it was on BBC recently. The young people were saying they have debts of hundreds of thousands of pounds, and the same thing in the US, you know, in student loan. So, but they will live, you know, on the outside, they will look rich because they have liabilities, they have all of these things. So for a middle class, most middle class people, they still have income, and they could also be a business owner. But what you hold from a personal finance point of view is mostly liabilities. And remember what liabilities do. They take money out of your pocket. So its income comes in and it goes out on the liabilities as expenses, with nothing going into the asset column. And this is the cash flow pattern of a rich person. A rich person makes income. Either he could also make it from a job, but he has learned to also build his asset column or asset column. So the asset is actually what is making income for you. Your goal really, from a personal family point of view, is to grow your asset to the point that you really don't need a job or a business that has to give you money on a regular basis. Your assets themselves can produce enough income to cover all your expenses and more. That is when the individual is rich. That's where their run rate is high because they have good coverage. Okay, so our goal in this class is to think through what are the things that will help me to build my asset. It doesn't mean we won't have liabilities, because this individual will still have liabilities that will take money out of his pocket. But at the same time, you're building your asset column so that your asset is making income, either rental income, dividends, interest, royalties, and so on and so forth. And there are different investment vehicles that I will be teaching us, not in today's class, but in another class. Any question about this slide? This slide is always an interesting one that I always like to kind of maybe slow down and see if people have any question or comment on. I actually want to ask you to don't answer us in the class, but who are you among these different cash flow pattern? Where do you fall?
Oh my goodness. It's so interesting, because I was already thinking about it, and it seems like I don't mind saying, because I have mortgage. I own 1, 2, 3, the fourth one, but yeah, because of the mortgage, I thought like car loans were really bothering me, and I have tried my best to get rid of them. And by the grace of God, I've been able to. However, the credit card is just like every time get rid of it, and then I use it again, and then it goes up again. Thank God, no school loans. So does that matter if you have maybe just one thing there, a few are not there? Another thing, just to, since I'm talking, just give another thing is like the power, the compound interest. So the biggest problem is taken out, but you can always put in, right? If I see that my run rate has grown to a pass, because you keep putting, you're saving, basically. You're saving. That's what allows you to run. But then they say like, okay, I have a lot here. I have reached the 8th month. So if I see that's more, I can take that and then add it to my stocks. Add it like to invest, right?
Yes. Remember,
Okay.
your goal is to grow your asset column without
Mm.
putting yourself in jeopardy, of not having money to take care of your daily needs. And at
Okay.
the same time, not grow the asset column at the expense, of money that you need in the short term. So your goal, once you meet your run rate target, let's say 8 months, to make it simple, instead of saying 6 to 8 months, your goal is to build your asset column, because your asset column is what will produce income in the long run. And that is where you want to be. And I will talk about various investment vehicles when we get to class 2 or class 3. Yeah. So first of all, thank you for being willing to share that you see yourself. So it's between these last three, what you're saying is you are
That
the
one. Yes.
truth, you are not alone. Many people, it's sad, are in that box. Many, many, many people. Because we have not been schooled, we have not been taught, and it's so sad. But there are ways to overcome this, and this is the goal of this class. This is why we are here. Okay, the goal
Now,
is to.
Bro Larry, I'm sorry, but if for from one item, let me say, if one item from the last column moves to my the asset, for instance, real estate is what is the house you own, right? I know I'm not done paying, right? I'm not done paying, then I'm just doing like, okay, I'm at mortgage. But the moment you have a house that you put for rental, then you move to the next one. But it doesn't matter if it's even one house, or does it matter when you
So real estate could be, so for most real estate, unless you pay cash, you will have both sides of the balance sheet. Whether it's the one you live in or a rental, you will have it as an asset, but to that asset, there'll be a mortgage, there'll be a liability.
Okay.
The difference between the two is your equity in that real estate. Okay. Your goal is to lower the mortgage to zero as quickly as you can. And I will teach us, I don't know if I've taught you this, Sister Celeste, on how to do it. I'm going to be teaching it in this class, in class 3. I was talking with someone today that said in 4 or 5 years, this individual has been able to cut out another 3 years mortgage by just paying just a little towards the principal on a monthly basis.
Yeah,
And
that little can be calculated so that way.
Yes, I can show you how to calculate this to the last penny. You know, I have a worksheet that I share in class. Yeah. All right. So your goal is to begin to lower the liabilities, and the nature of assets is it's one of those things that could grow with the market. So the value of an asset could grow because of just what's happening in the market generally. You know, so as your asset is growing in value, and your liability is going down, you are growing your equity. That is your goal, because your equity is your net worth. That is your goal. That's what you want to grow. So don't beat on yourself that you are in this middle column. There are things that you need to do. It's not going to happen in one day, but I can assure you, if you follow some of what we'll be learning in this session, God will help you to move from where you are to the point of the final column, which is where
Amen. Amen to that. For the intellectual property, I can just write one book that works, right?
Yeah, why not? As long as it sells well, that will become an income generating for you.
All right.
All right. Thanks for contributing. So step 1 is know these 3 numbers, or these 3 elements. Think about all of how it all plays into this. And then step 2 will then be, now that I know where I'm at, the question is, where am I going? And this is really where I will probably kind of want us to please pay attention quite a bit to what I'm going to be saying in the next couple of minutes before we close tonight. Where am I going? This is probably the most important question to ask. It's important to understand where you are. All you are doing in this first part, net worth, bond rate, run rate, is to understand where you are at. The question next is, where am I going? Because if you don't know where you're going, it doesn't matter that you know where you are. And of course, if you don't know where you are, you can't even talk about where you are going. So both sides of the equation are important. Okay? And I was saying this earlier on, that you should know your whys. Sometimes in the class, I just ask people, what are some examples of what could be a why for someone to want to be financial free, just to open it up to a conversation. What are some examples of a why for financial freedom? What do you think? Anyone can respond to that question. What could be a strong motivation for financial freedom?
For me, I know, like right now, I have a strength to get up in the morning and go to work. But as you get older, you might not have that energy anymore. And the nature of what I do, working with students with disability, it gets to a point where you're old. Whatever they'll be doing might not, it's not that you don't want to help, but the patience, your age, your bones, and everything. So, speaking of health wise,
Thank
It's
you.
gonna be a time that we're like, you know what, even Jesus, God rested. So
My
you want
sister,
to rest?
it's not whether it will happen. No. You say maybe
It's
it
coming.
is going to come.
It's
Whether
coming.
you realize it or not, it's
Whether you like it or not.
of the process of life. The energy I had when I was age 20, I'm in my mid 50s now. I still run once in a while, but I don't run like I used to do then. I take my walks now. Why? Sometimes if I run too much, I bought a sneaker that can help, but I will have knee pain.
Yes, and you don't want that.
Part of the process of life. So I like that. Why? The energy you have today, you are not going to have it at the age of 65, 70. If you are 30 today or in your 20s, that you need to prepare for your tomorrow today. That's why the Bible actually says we should go to the height. That in summer they prepare for their winter. You notice that ants don't come out in winter. It's too cold for them. But they have food to eat throughout their winter. You'll see them during summer. Summer has started now. You'll start seeing them walking in a line on the sidewalk. They will gather the food. One little hand will carry one big thing that is bigger than his head. It's taking it to a storehouse.
To the
They're not
colony.
eating it today. They are preparing for their tomorrow. So that's a strong why. That is the energy you have today. The energy to be able to work 40, 50 hours today. You may not be able to do it when you are 70. Thank God if you can. But even if you can, should you?
Yes. And another why is that, of course, retirement gets here, and then, okay, I'm not going to work. Then now what? You wanna maybe visit places that you weren't able to visit when
And,
you were working.
for me, I'm not waiting for 65 years old. No, I'm already living in retirement, in all honesty.
Okay.
Yeah, I'm living the life that I will live in retirement. I may not
Good.
as much, maybe not as much time that time, but I take breaks. My wife and I will travel all the time. By the grace of God, our children are out of the house, so we can do that also. We just
And
pack.
then for that, where do you put your hand? You put on the run.
No, you have to plan for it. So that's a different question.
Okay.
That's a different question. So that you did. So this is where budgeting comes in. I was going to get to budgeting. That's not part of your regular run. That is your budgeting. We'll get.
Okay.
All right.
Yeah,
so
those are the two whys that I have right now. Like, and also another thing that has affected the way I personally budget is being immigration. So it has and I know I'm not alone. It has affected a lot of people. Some people, when I get to America, it took us 3 months. Oh, we got our green cards and blah blah blah. Everything went. But to be honest with you, I have had at least 8 lawyers. That's the one I can count. I don't, and what sometimes they would transfer your file to somebody else. I'm not, but the ones that I can remember that to share our income with, at least 8, and lawyers are not cheap in this country. and not any lawyer. I mean, immigration lawyers are not cheap. Now times 4 members in the family. So a lot of our income has gone that. But now that you thought like things were normalized, and then boom, something changed. The administration changed, the laws changed, everything changed, and then some members of the family can work, some cannot work. So you now, as an adult, you have to share your income. You have to budget for theirs as well as adults, because some members can work, some cannot work. So the dynamics around it's been affecting.
It's little challenging. No, I feel for you, and I appreciate, that I completely understand, However, my prayer is that God will help despite all of that, to give you wisdom on how to do some of these things together with what you're doing. The Lord will give you grace. So thank you for sharing. I like that. So, but the question is, how do I define my goal? So now this takes us to a very, very interesting.
I don't know if there's anybody else that has a different why that they won't share. So
yeah, it's okay. Let's move on in the interest of time.
okay.
I'm sure somebody else will have, but let's just move on. You know, I want to share this principle on the time value of money. You know, a lot of us, we know this intuitively, but we didn't know that there is a mathematics to it. It's the mathematics that works on credit card. It's the mathematics that works on mortgage. It's the mathematics that works on compounding. It's amazing how simple yet how powerful it is. We know it intuitively because we know that the cost that maybe 3-4 years ago, when you go to the market to buy a loaf of bread, for those that eat Jolly bread, Jolly bread used to be, the big one used to be like maybe $2 or something. I think the same thing is probably like $4 now. What has happened? It has been affected or impacted by inflation. I remember when we moved to Houston, a gallon of is it a gallon or a liter? A gallon of gasoline used to be less than $1. I can't remember when last I saw gasoline less than $2.50. Even in Houston environment where our gasoline price is relatively lower. What has happened? Inflation. So every dollar you have in your pocket will always lose value annually. I sent a video for us to watch on the platform. It's like an interesting cartoonish video by Ray Dalio talking about how the economic machine works. Please, if you've not watched that video, go and watch it. One of the reasons I share those things is there are some important lessons that, because of time, we can't delve into the detail in a class or in a session like this. So when I share those things, it will help you to deepen your knowledge. One of the things I want to do is grow our knowledge. Knowledge is powerful. You know, why is there inflation? Why can't things just stay at the same price forever? Why? There's a reason to it. So please watch that video. Well, anyway, to summarize it, is because of inflation. And the principle I will explain here is this. Let's say I put an amount of money called P. Let's say P is $10,000, but P is the principal that I have. If I invest it as an interest rate of I, at the end of 1 year, that means my P would grow by the interest rate multiplied by the value of P. For if I use numbers, for example, let's say P is 10,000. If the interest rate is 10%, 10% is an annual quotation. Whenever the quote returns, it's always an annual number. So 10% of 10,000 is 1,000. That is, interest rate times the principal is the interest you will earn. So 10% or 0.1 times 10,000 is equals to 1,000. So you add that 1,000 to my 10,000. At the end of 1 year, I will have 11,000. And that is simply what I'm explaining in this algebra over here. So at the end of year 1, my P invested at an interest rate of I will be equals to P plus the interest that I earn, which is the interest rate times the principal. And if you remember algebra, you can simplify that into, take P out of a parenthesis. What would be on this left side of the plus will be 1, plus I is the only thing left on this other side. You can expand that to 2 years, because at the end of 1 year, if I reinvest what I now have, which is P into 1 plus I, at the end of year 2, my money will now be P, the amount I started with, plus the interest rate times the value that I started with at the end of year 1. So P into 1 plus I is the principal I have at the end of year 1, year 1, which I invested. At the end of year 2, I will now add to it interest rate times all of this is now my principal, P into 1 plus I. So you can simplify it again by bringing 1 plus I out of the parenthesis. And then you can write it like this. So P into 1 plus I, then there'll be a new parenthesis here. Maybe I can make it slightly different, which will be on this side, because P into 1 plus I is now equal, same thing on both sides of this equation. And what is left here will be 1, and what is left here will be I. So that is equals to P into 1 plus I into 1 plus I, or multiply. Or you can write it in this form, P into 1 plus I to the power of 2. And that can be expanded to n years. And that gives you the equation of present value and future value of money. Okay? So what I will have after year n is P into 1 plus I to the power of n. Just as in year 2, I have P to 1 plus I to the power of 2. In year 1, I have P into 1 plus I into the power of 1. Generally, in algebra, you don't write the 1 when it's 1. Anything greater than 1 are the only ones you keep. So P into 1 plus I to the power of n. So future value of money equals to the present value multiplied by 1 into the plus the interest rate to the power of the number of years that you leave that money invested. So I is the rate, interest rate for future value. You can turn that around and calculate present value from future value as well. So if this mathematics, I just do a simple algebraic manipulation. I divide both sides by 1 plus I to the power of n. I will have only PV, or present value, on one side of the equation. And now I will have future value divided by 1 plus I to the 1 plus I to the power of n on the other side of the equation. So the present value of a future amount of money is equals to the future amount of money divided by 1 plus the interest rate, or in this case, called the discount rate, because you're bringing future money into today, divided by 1 plus the discount rate to the power of the number of years that you want to use to discount it to today's value. So tomorrow's money, I can calculate the value today, is what I'm trying to show us here. And money today, I can calculate its value tomorrow. And I have an exercise here that I normally ask people to do in this class. I'll just run through it. You can do it using that equation that I just showed you. What is the value of $61 invested today at 5% in 10 years? Can somebody do that calculation using this equation quickly and tell us? So I'm saying, what is the value of 61.39, which is now your P? Your PV is 61.39. Your I is 5%, 5 over 100 or 0.05. Your N is 10. Who can do that calculation for us quickly? Anyone, or it's too much numbers? Can anyone do that calculation quickly and tell us what is the value of $61.39 invested at 5% interest rate in 10 years?
I'm not a math. I'm English.
I know I have engineer.
Math.
$100.
Thank you. $100.
Oh my gosh.
So if I invest $61.39, I put it into an investment that is yielding 5% per annum, and I leave it for 10 years, it will be worth $100. And that's actually the reason I have this example as number 2. And I say 100 years in 10 years from today is how much today, if inflation rates, I'm just turning the same thing around, really. So $100 in 10 years is actually the $61 of today. So if I have $61 in my hand today, and I don't invest it, in that 10 years, it's not going to be worth $61. Or let me say, if I have $100 in my hand today, in 10 years, if I don't invest it, assuming the rate of inflation is 5%, it's actually going to be worth $61 off today. So I'm actually losing money. And that's why I tell people all the time, the worst thing you can do to yourself is to keep cash. From a finance point of view, you need, don't forget that I said you need your run rate, okay? So that's a different thing. You need that one, or close to cash. Other than that, you don't keep cash, because it's going to keep losing value year after year after year. You can still keep this $100 in your pocket 10 years from today and be jumping around, but the thing you can buy for $100 today, you will not pay they will sell it for you at the same $100 cash that you have today in 10 years. Because at that point, that money will be worth $61. So you probably need $140 to buy the same thing. And that is what brings up the principle of nominal and real value of money. Okay. Money today is not the same thing as money tomorrow. So $100, you might keep it in your pocket for 10 years and it remains $100, but that is the nominal value. It's just the number written on the paper. The real value is what that money can buy in 10 years, which will be only what $61 can buy today, not what $100 can buy today. You know, it's because money loses value with time. So it brings up the concept of the time value of money, you know. And as a result, I always tell people, you need to invest. You need to invest. The question is, what do we invest in? And we'll talk more about that. And how does that work? I can do another example, which is just the same thing. I'm just, you know, doing it in this slightly different way. This is the answer to the question, the second part of the question. You can see that it's the same 61.39. Additional question that I will ask, could ask you is, should you invest $61 in an investment? Please listen to this. Yielding 5% return on investment if the inflation rate is 5%. Anyone, what do you think? Should I invest that $61 that we're talking about if the return on investment is going to be 5% and the inflation rate is also 5%? Yes, go ahead, Phil.
I would not do that. It simply means there is no net benefit for me, really.
Okay, good. Let me ask a slightly different question to that. If you keep the $61 in your piggy bank, how much will it be worth in today's value in 10 years? Assuming inflation is 5%. You can calculate it. It's the same thought process. You just convert this 100 to 61 and all of that. And I think it's around $40-something. So the correct answer is what you said. That means you need to be looking for an investment yielding more than inflation. It's what Philip is teaching us. If your rate of return, if your return on investment is barely meeting up with inflation, you are not, if you heard what Philip just said, you are staying at the same point in principle. So you need to understand what the rate of return or the return on investment is in a given environment and what the inflation rate is in that environment. Some people will tell you, for example, if you take money to Nigeria, you can have like some savings that will give you 18-20% rate of return, or return on investment. But the question I will ask is, are you spending that money in Nigeria or outside Nigeria? Because if you're spending it in Nigeria, you're probably better off not investing in there, because the inflation rate in Nigeria is more than that 18%. So anyways, you need to understand what is the inflation rate where you are investing and what is the kind of return on the investment that you are going to get back. And to the second part of this question, if you keep that money in the piggy bank, it's even worse. At least this person invested it and is just matching inflation rate. And after 10 years, his money will stay at that same $61 or so. The man that puts his own under his pillow, his money will not be worth $61. After that 10 years, his money will be worth much less. Okay? So I can't say this enough. One of the worst things you can do when it comes to money is to be afraid of investing and just keeping it at cash. A lot of Nigerians like to keep cash for some reason. But it's losing value. Okay, now why are we talking about all this? It's really to talk about how do you set a future goal. Remember, I was explaining this earlier to Philip, that this is where your goal is to grow your net worth by growing your asset column to things that are making cash that keeps going back into the asset column, and you're almost like in a nice cycle of keeping your assets growing. And I will open an Excel spreadsheet to explain this in a minute. But I wanted to start by showing us the power of compound interest. The power of compounding, I said earlier on that Albert Einstein says is the seventh wonder of the world or something like that. Let's look at some of these numbers. This is somebody investing $60 on a monthly basis. So 60 times 12 is $720 and continuously does so for a number of years. The kind of numbers that you see at the bottom here after time, it blows my mind. This is 20% rate of return is not sustainable. So I'm not saying you will get 20% rate of return. But how can $60 a month become $200 million? Does that not sound strange?
Would they really give you that money after if you, for instance, after a while you said, okay, I want to touch my money, can it give me all my money?
Yeah, you get your money. Once it's mature, you get your money. What I'm trying to illustrate here is the power of compounding. I mean, the first thing I want to shock our mind with is how can $60 become $200 million? That doesn't seem like possible, but it's more than possible. The power of compounding is time. Let me show us something quickly here. The general rate of return that you get in most good investments in the Western world, I'm not talking about going to some other places where the inflation is pretty high. I mean, in the West, is between 10 and about 12, 13%. You can expect to have good investment that will yield you in that range. We'll talk about asset allocation, some other class, next class also. But you can expect to have returns in this range of 10 to 12 to 13, compounding on an ongoing basis. Now, it doesn't mean it will always do that. Some years, and I'll show you some things later, it might do 3, it might even do negative. But on the overall, you can get 10%, So let's even say let's stick with that 10%. $60 becomes $2 million.
That is in 60 years, right?
60 years.
So that means my grandfather should have put it there when I was born.
Exactly. But Sister Celeste, let's think generationally. That's part of the problem with us. We don't think generationally. We only think what we need and after us and for us. And we need to think more than that. But more importantly, I want you to understand the power of compounding. So first of all, let me show you something. That's $60. After the first 2, 3, 5 years, how much have you contributed in 5 years? If you contribute $720 a year, how much is that in 5 years? Can someone do it? 720 times 5, how much is it?
36, right?
Yeah. That's 600. Exactly, or a little bit more. That's exactly
720 times what?
Times 5.
That's exactly
3,600.
Right. Okay, so how much has that money grown at 10% in 5 years? It's 4396 minus 3600, which is like, let's say 800, less than $800.
So the table doesn't show us.
The calculation is running. I'm not.
Okay.
I don't have I'm going to share this worksheet with you later, and you can work on it and spend. In fact, it's part of the exercise for tonight or assignment. I just want you to see something. Please listen to this.
I always need the calculator.
After 5 years, your money has only grown by $800. After another 5 years, you will have invested 7,200. That is 720 times 10.
Oh, no,
you will have invested 7,200. Yeah. How much has it grown? Just about 4,300. But look at what now happens after the next 5 years. It took you 10 years for you to grow this money by, I think around 4,000 is what I said now. 5 years from then, it doubles. The next 5 years, it doubles again.
It keeps doubling.
This is why I tell people that if you want to invest in the stock market, your minimum time frame is 10 years, because that is when the power of compounding kicks in. Anything before 10 years is going to grow, no doubt. but the power of compounding has not kicked in.
So for that, we have to do like annuities. You put and you forget it. In other words, I don't say that you forgot the money is there, but there
I will
is.
tell you different investment vehicles. Annuities is just one.
Okay.
Yeah, so we'll
Okay.
talk about it later.
Okay.
But my point, the principle I'm trying to teach us here is it took 5 years to get to 4,003. Another 5 years, it got to this level, but I've already invested like 7.2 before I got then the next 5 years, I'm still only going to invest 3,000 something, 3,006. So 3,006 plus 7, the total I will have invested in 15 years is 7.2 plus 3.6, which is like 10.8. Correct? So 10.8, but look at it. The money now grows, like essentially doubles, because all I put in the next 5 years is just 3.2, 3.6, but now I went from 11.4 into this amount. That means my rate of growth is now at an exponential level. If you look at the next 5 years, so after 20 years, you can actually multiply 720 by 20, and that will give you 14,000 something, right? But 14,000 is now equals to 41,000 after 20 years. So I invested 14, but now I have like 37,000. But my point is, look at the rate of growth in the first 5 years, the next 5 years here. It's not the same that starts happening 5 years, 5 years, 5 years afterwards. Let me actually open. I have the actual spreadsheet open in the background. This is the actual spreadsheet, and I have the formula in there, the FV. You can see in the formula section, the formula bar, I have the FV calculation in there. Okay, so it's converting, it's multiplying. So if I put this in this column, it's using the time and the interest rate to convert my annual investment into the calculated future value based on what I was showing you FV equation earlier on. It's an Excel formula that makes it possible for you to do this without having to do the manual math. For someone that may not be easy to do the manual math with the calculator, the Excel function does it for you automatically, brings down and calculates it. But look at it. It's amazing. Compounding takes on the power of exponential growth after about 10 years. And that's why I don't want you to take the money that you put in the market and take it out, because it loses you just lost the first 8-10 years from that point, and you're back to square one, and you're going to start growing it from there again. Whereas if you just leave it for the next couple of years, because compounding has now taking effect, it's now almost doubling every 5 years. So please, 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 I can't say this enough. Don't take money that you have in the stock market out before 10 years. If you do, you're going to lose money. And I will show you this on a chart. I don't think I'll be able to get that today. I'll show you this on a chart. If not today, the next class. You are going to lose money because the market is always fluctuating. But if you maintain a long time frame with the minimum time frame you have in mind being 10 years, it will blow your mind how your money grows. This is $500 invested every month, so a total of about $6,000 a year. After 35 years is 1.6 million. The next 5 years, which is year 40, is essentially almost double at 70-80% growth. How can? Yet, if you look at what is happening the first 5 years, it doesn't have the same rate of growth because the exponential function, the end function, has not taken effect. It takes about 10 years before you start seeing the power of it, as I showed in that calculation earlier. So please keep that in mind. That was why I was saying earlier on, Sister Celeste, don't take money out of stocks to go take care of short-term need. You break the power of compounding when you do that. I hope that makes sense. I mean, look at this kind of number.
Thank you.
I'm not saying that we can get this kind of returns, and I don't want you to expect it, but I just want to shock you. $500 a month equals $10 billion.
So, per experience, what have you seen? How far have you, like, at least heard that has happened?
That's not going to happen because you can't. So what I have here is, compounded rate of return. Okay. That is, even let's say in some year it was negative, some year it was positive, but overall you are averaging this amount. This you can get, and I will show you some things shortly. This you can get. That's why I always use the 10%. We should not be greedy. This is the problem with people. They want to, because they want so much. The higher your returns, the higher your risk. You might actually make 20% in a year, but you shouldn't expect to get that every year consistently. You see what I'm trying to say?
Yes, sir.
And what this is showing us is what on the average you get consistently. That's what this number in row 6 is. So it's not like you can't make 20%. I've made 20% in some good years. That's not a problem. But you won't consistently make that. So you can't base your estimation and calculation on that. I hope that makes sense. I just wanted to that it's even possible that $500 a month can become 10 billion, assuming we can get 24%. It's almost unfathomable. But you see, in the first couple of years, it's not that same growth you get. But the moment you start hitting that year 10, it starts growing 1 million, 10 million, 15 million, 36 million, 100 million. And it's crazy how it works. It works like magic. It works like magic. And that was why I was saying at the beginning of this class that it's so simple that people miss it. It's so simple that people miss it because they are looking for the spectacular. They are looking for big breaks. They are looking for money come to me now. You know, the kind of prayer we pray sometimes. That's what most people are looking for. Yet it's so simple. It's simplicity, continuity, and sticking with it, regardless of what somebody is saying on CNBC, sticking with it. Now, this is how you now calculate where you want to be in future. And that is really where your net worth thing I was explaining. So let's say today you want to say, look, in 30 years from now, those of us that are already in our mid-50s, you probably don't have the luxury of saying in 50 years from now, but you can still say 20 years from now. You can still say 30, 40 years. Those that are in their 20s, maybe there are a few of us on the line. I don't think anyone on the line. Maybe one is in their 20s. They have a longer runway, so they should be thinking 50 years.
By 20 years, you are shaking. You're afraid of the airplane. You don't want to go in Greece anymore because you don't want to climb out there. That's the problem.
But my point really is, so let's say someone is just leaving college and you can say, look, by the time I turn age 50, I want to have $2 million as my net worth. Assuming I can, which I know you can, compounding 10% per annum, about on the average of 10 to 12% that is in this box per annum. How much do I need to invest on a monthly basis to get to that? That's how you use this sheet. And you simply change this cell. The version I will send to you, I made this in yellow, I think, and I said, just change this number. That's all you change because the formulas are all linked to this number. So you can put, like I have here, like this cross, to kind of make it meet at a point. Let's say 10, you can do this too. I say between 10 and 12%, somewhere in that range. Put a box like this. All right, so if this individual just leaving college in 25 years wants to know where they will be, and now they are 25, so they come to this cell and they work on this column. And then they will say, okay, if this is where I want to be, I need to put a box around it like this. How much do I need? See what happens. I'm going to change that to 600, that number there. It changes to 200, and you see that I will highlight this as yellow. It changes the number in this. So you know that if I put $600 a month and I invest it consistently, I'm going to be able to get close to $1 million. Okay, so maybe that's too small for me. So I'm going to make it 1250. If assuming you can do that. So 1250 puts you at 2 million, essentially between 1.5 and 2 million. So that means that investor says, okay, this is what my savings plan is. And so you walk back from the future using this future value continuous investment sheet, which I'm going to share with you. In fact, I'm going to give you as an assignment tonight to work on this, and it's going to help you to develop your plan for your family. Okay, does that make sense what I'm trying to explain to us on this sheet?
Yes, but for us that are mid 50, mid 50 and
you wouldn't put 25 years. You will probably say 10 to 15 years.
Okay, right? For 10, but what about a lump sum works?
Yes, okay. You can do lump sum. So it's not this sheet. This sheet is continuous investment. There's a sheet here that you use for calculating lump sum, which actually simply use the equation that I showed you earlier, FV equals PV into 1 plus I to N. So it's just one amount.
I'm interested in the lump sum. So,
yeah,
do we have that sheet?
Yeah, this sheet, I'll share it with us.
Okay.
But really, okay, so you need to do both. Let's say you have some big amount of money now that you want to see what the value will be in the future. You use this sheet, but you use this one when you know you're going to be contributing like monthly, ongoing basis, and then you want that. All right, so lump sum. So if you have 50,000, just put 50,000 here. After 25 years, it will become 541,000 at 10% per annum.
Let's do 100.
Okay, so 100,000. It depends on the rate of return. You're probably not going to get, for lump sum investment, you may not get 10% rate of return. So you probably get, let's say, 5%. So where you will be in 25 years will only
How
be.
about if you put that lump sum in stock market? You can still get the average.
Brother Philip, you are quiet there. You want your own lump sum.
So that is not lump sum. So when I think lump sum, I'm thinking like a fixed investment, like low rate of return. Once you start putting it in the market, yes, absolutely you can get 10%. Not that you can, you will, as long as you leave it and you don't go touch it and mess with it. If you leave it, that 100,000 will be in 25 years 1 million. Does that make sense?
Yeah, it does. I mean, I've been practicing this, so it's not strange to me. Right. But the other thing I could just, if I may want to, I don't know whether this will be deviating a little bit, but it's still in line with this. If I know that I can get a return on investment in Nigeria, as high as 18%.
Yeah.
And the max I can get here, right, in similar instrument is probably 6%. I know if I go into stock market, it could be higher than that. But let's apple to apple. Would I rather take the fund I have here, invest it in Nigeria, and then bring it back here?
So what you are talking about is what in financial terms is called arbitrage. If you can create arbitrage, it's powerful. Now, the question really is, can you move that money to Nigeria and move it back up? As long as you're going to be spending the money in Nigeria, it's the same thing as getting 6% here, because the risk is lower here. That's why you're getting a lower return. Once you take that money to Nigeria, if you're going to be spending it in Nigeria, the rate of inflation in Nigeria implies that you're going to be facing a similar circumstance, because that money will be eaten into by the inflationary rate in Nigeria. However, if you can create an arbitrage, that is making money without the risk that goes with it, that's what an arbitrage is. That is, you take the money to Nigeria, make 18%, and then you bring it to spend in the US, then that's a good thing if you can do that. Does that make sense?
But
yeah, it makes sense on paper. I guess the risk that you also did not mention is actually the exchange rate risk.
That's what I'm saying. So the higher the risk, the higher the reward. The reason that you're getting that kind of return is because of the risk associated with it. And there's the exchange rate. There is a lot of things. What if the government changes and they now say, no, you're not able to move your money out? Even here in the US, there are laws that goes with moving a particular amount of money. Arbitrage is not an easy thing to create. It's a very difficult thing. If it's easy, everybody will be doing it. You know, so once you move your money into that environment, the likelihood is that you need to spend it in that environment, in which case you don't have the benefit of arbitrage, you know, which is making money without risk. You're going to have to face various risks: foreign exchange, government policy, a lot of other risk that goes with it. But again, in theory, it's doable if you can overcome those risks. Then that means you're able to make money at a higher rate, but spend it where the rate is lower. If you can do that, then that would be, you know, of value. Arbitrage, though, is not easy to create. It's very difficult. I mean, on scale, we can do it in a few $1,000s. I mean, obviously, I'm talking about scale here. Does that make sense?
Yes, absolutely. Thank you.
I think one or two last things. There's what is called the rule of 72. If you divide 72 by the rate of return that you are getting, it is the amount of years that your money will double. So if you divide 72, let's say you have a rate of return of 10%. After every 7.2 years, your money will double. Okay, so it's called the rule of 72. It's a simple way to see how quickly what you put in can grow to a particular level. And it's simply doing what I did on that spreadsheet, but it's called the rule of 70. I wanted to share that with you. Okay, our time is up, and I think I will let's see. This is a very important thing. I don't want to rush it, but let me just introduce it a little bit. I will pick it from there the next class. This is what I was saying earlier, that one of the things you want to avoid doing in the stock market is to maintain, I already explained it to us from the point of view of compounding, that it's about 10 years before the exponential function truly takes effect. But on top of that, if you look at this chart on the right, this is $100 invested in 1988 up to 2020. Based on just general total market in the US, average return, it will be $2,153. So it's going to go up by about 200%, is it no 2,000%, you know, something like that. But if you really normalize that around the average, you'll notice that depending on where you come in, you might lose money. If you leave it for this period of, I think that's 32 years or something, whatever that is, 32, it's going to or the overall you make money. Even despite inflation, you still, I mean, 2,000%, that's a lot. However, if I invest here, I hope you can see my mouse. Can you see my mouse? Or maybe I should use, where's the pointer? Pointer options, laser pointer. I think this is easier. Can you see my pointer?
Yes,
Yes,
please.
sir.
All right. So if you come in and you invest at this point, and then maybe somebody lost the job and then they had to sell it here, that person will lose money. If somebody else goes in and invests here and thinks he's lucky and it gets out of the market here, it will make money. The sad thing is that person will think that's the way it works, and then will put more money the next day, and then the market starts crashing for another 2 years or something. And then it keeps going up and down around the mean. See what I'm saying? So if you maintain a short-term perspective, because this is driven by people that are trading daily and trying to make money off the movement of the price of the stock. I'm not teaching us day trading. I'm teaching us to invest. I'm teaching us to maintain a long-term focus, which minimum, as far as I have explained tonight, is 10 years. You know, if you do that, it doesn't matter what is happening on the short run. in the long run, you will be fine. This is S&P 500 from 2009 to 2020, just about 11 years. So an investment of 800 will grow to $3,200. But similarly, you can see that a number of things happened along the line that could cause you to lose money, you know. So if you maintain a short-term view, that's why I said earlier on, you will lose money. If you look at this table on the left, in 2013, the return on S&P 500 is 32%.
Jesus.
But at the same time, in 2018, it's minus 4.4%.
Hey.
So if I came in at the beginning, I would lose money, and some people will then be scared and then they'll get out of the market. But look at what happened in the next year. It returned back 31%. The overall average of S&P 500 has been around 12-13%. So the general market, overall market, based on Goldman Sachs data for about 140 years, is the rate of return is about 9.2%, for 10 years. That's not bad at all, And S&P 500 is about 12-13% is usually what you get in most statistics. So you can see it even in the table that I have here on the right. This from Berkshire Hathaway from Warren Buffett, So anyway, the key point here is that you must maintain a long-term perspective. Short-term, you might make money and you might lose money. But if you maintain a long-term perspective, I'm using the stocks as an example here. This principle is true regardless of the investment vehicle. And I will teach us about various investment vehicles later. Okay, so let me wrap up by saying, let me put it back in my presentation mode, by saying this. I will talk about this next class. I won't, because of time, I was already after 8. I will kind of start back from the last slide, but I want to give us this assignment. I've given us one assignment already. I have 2 more assignments. I don't think I have it open right now. Let me open it from my, give me a second, please. And I'm going to send this to Ross so that we'll work on it at our own time. Is the assignment for class 1. The first assignment is to calculate your own net worth, burn rate, and run rate. Okay, I already taught us how to do that, or we talked through it, so it shouldn't be difficult to do. Okay, so just follow the examples here, which is same one that I shared with us earlier on. Just follow it and calculate your own numbers. Again, reach out to me. Second assignment is you will use the compound interest and future value worksheet, which I will share with you, that same Excel that I just showed us, to look at what is the value of $100 a month in 5 years, 10 years, all the way to 60 years from today at 10% and 15% rate of return. Okay, I explained that to Ross. Maybe I ran through it quickly, but when you do the exercise, it should come to you. But if you have any question, please reach out. At the beginning of next class, I'll ask someone to share with us what you get from question number 2, assignment number 2. Then I kind of talked through this, that if I'm age 25 today and recently finished college and I desire to have 1 million, this is goal setting now in investment value at the age of 50. How much will I need to invest monthly to achieve this goal of 1 million? If my cumulative rate of return is 12%, again, you just use that Excel. If I only invest 200 a month, but do so consistently, at what age will I achieve the $1 million goal? Okay, so 3 questions, use that spreadsheet, which I will share. And the third is, as a preparation to next class, on budgeting, please determine your personal or family investment goal and have it written down. You know how to do that now, correct? Using that template. And I said here, using the future value template, evaluate your monthly savings and investment requirement to achieve the goal. And we're going to work on it a little bit more in terms of numbers in the next class. But I want you to kind of do this as an assignment in preparation for that class, so that when we start talking about it, it makes sense a little bit more in the class. Yeah, these three questions, are they clear? Do you understand them? Is it too much numbers? Burn rate, run rate, net worth. Calculate them for yourself. I'm saying your own numbers now. Okay, you need to start by breaking down all your costs, your expenses, and then you get your run rate based on your current assets, and then you look at your net worth. Okay, and then assignment 2 is just to help you kind of get familiar with the Excel that I just shared. And then thirdly, using that Excel, you now say, okay, if I want to get to $5 million at the age of 65, and today I'm 40, that's 25 years from now, how much do I need to set aside on a monthly basis? So all you need to change will be that that number at the top. So let me actually just help you a little bit here, because that's really the critical element here. So you just need to change. Say I put a note in this one that enter the monthly savings only. That's the only thing you need to change. Every other thing is a calculation that's already baked into the spreadsheet. So all those questions in that in this assignment, you can answer it using that spreadsheet. But again, if it gets too much for you, just reach out to me and I will walk through it. Our time is fast spent.
Are you sharing the spreadsheet, right?
Yeah, I'm going to send the spreadsheet and this assignment PowerPoint, these 3 slides.
Okay.
All right, our time is fast spent. We're already 12 minutes over. Does anybody have a last minute question, something you want me to talk about before we leave?
Yeah, just wanted to, I believe that should be the right thing, but I wanted to hear it from you. When you request us to do this investment goal, right? More like investment plan or what it will be, but that will be on, that will not add to whatever the number comes to. That should add to our net worth currently, right? That we have estimated.
No, well, yes. So if you're already at a particular point now, you're going forward from there, right? So this is assuming you don't have that. So whatever you calculate is in addition to whatever you already have. So you will add it to whatever you already have. Does that make sense? So let's say you're already at a net worth. Once you calculate it, you're already at $2 million net worth. And you now do a calculation of a goal. You're starting from where you're at. Remember, that sheet is from 0, right? This sheet, you're starting from where you're at. Is okay, I now want to add another $1 million to it at 12%. How much do I need to calculate? So I need to change this one till I get this to be, let's say this is 2.5 million. This person needs to do 860 a month to get 2.5 million in 30 years. So that 2.5 million will be on top of the 2 million you already have. So your net worth in that 30 plus where you're at right now will be 4.5 million. Does that help you?
Sure. Yeah, that's my understanding. I thought I should just also, ask you to hear your thoughts.
You're calculating from where you are to kind of think through to the future. If you already have attained something, you already have that. So you're adding to it. That's good. All right.
Brother Larry, I'm sorry. My spouse couldn't make it. So is there any way we can share the recording so that he can watch so we can do this together?
Yeah, I will. It takes some time before it's ready from Google Meet. And then once it is, I will load it into YouTube, and then I'll share the link with the class.
Okay, thank you.
Yeah. All right. I always like to do that because you can share it with other people. It's YouTube. Anyone can look at it. I'm not doing it to make money. I'm just doing it to share knowledge with people. So feel free to share it with others. You can invite other people to this session. Just send the link that I sent with you to them, or they can reach out to me to be part of the class. Those that have been in the class before, they don't have to, but you still find some of them attending. One or two people that are on the line right now, they've been in this class before. And people say they keep learning. Actually, I keep improving the material also as the Lord helps me. So it's still always something to learn, even after you've been to the class. So anyway, I will send the video. It might take a few days before I can do it, but I will send it. It's not going to be ready tonight. It takes like 2-3 days, and then I need to load it to YouTube as well.
Okay, thank you. God bless you.
Amen. Amen. Thanks, everyone. I appreciate your time. Have a nice evening. The next class will be on the 4th of April, same time, it's Saturday. But please do your assignment before then. You benefit most from this class. When you do your assignment, I can assure you, if you've not done this before, things like this might be difficult. But please reach out to me. I will walk you through it. Okay?
Okay.
All right. God bless you all. Let's have a nice evening.
Thank you. Same.
Yeah.
Happy spring break.
Thank you. Thank you, everyone.